sure that your microphone is on mute throughout the presentation, and the video on or off is completely up to you. So without further ado, let's begin. So over the quarter, the fund returned 7.68%, which was just under 200 basis points above the blended benchmark. Our outperformance can be largely attributed to the healthcare, energy, industrials sectors, but was offset by underperformance in materials and consumer discretionary. So currently the fund has a 40-60 Canadian US equity exposure. However, we are comfortable with the overexposure in the US equity due to the quality and growth profiles of our US holdings. So over the quarter, we did not conduct a significant amount of transactional activity. However, we focused on technical development and company research. So a huge portion of that was attributed to the Marquee financial modeling session with the Marquee Group prior to the annual IA pitches at the end of August. So while no new names were purchased over the quarter, the fund actively managed its position in Apple. Following the rally with tech stocks, we trimmed the position in Apple twice, early in August and September, to meet compliance requirements to have no holding over a maximum of 7% AUM, which allowed us to realize incremental returns. And so while we made these transactions and changes, we still remained a strong conviction on Apple throughout this time period. So similarly, we recently trimmed Intuitive Circle from an AUM of 5.7% down to 2% for a similar reason. So just to reiterate our current and future holdings, the CPMT's mandate and investment philosophy includes a growing free cash flow to allow the company to pursue opportunities that enhance shareholder value, pay dividends, reduce debts, or make products and make acquisitions as well as strong balance sheet in which a company demonstrates resilience in economic downturns or booming periods, structured to the business's goals and financial performance, following by intelligent working capital for core fund operations, appropriate capital structure, and income generating assets. And moving on to a competitive advantage. So the company must demonstrate clear competencies across a variety of facets, such as operating efficiencies, technologies, first mover, market presence, etc., followed by quality management to assess the control, compensation, ESG, diversity, inclusion within the companies, but also to translate downwards as the value of the company, performance, earning targets, and etc. Moving to the next slide to discuss analysis and notes. Our top performing holdings to the overall quarter to date returns were included Apple, Cintas Corporation, Intuitive Surgical, Abbott Laboratories, and Costco, while the bottom returning names were Suncor Energy, Knight Therapeutics, and Enbridge and Aritzia. So the latest 2 quarters has allowed the CPMT to both realize incremental gains, but strengthen our fundamental analysis of the fund and its holdings, and also to increase accountability of our decisions and our mandates behind our thesis, our actions, and where we'd like to drive forward with the fund, as well as allocate capital to upcoming opportunities. So the CPMT is confident remaining in line with current weights of healthcare, industrial, consumer staples, and consumer discretionaries, as we believe these fundamental names within the sectors will positively contribute to the fund performance in the near term, with proposed swaps and additions as per the mandate. Just to elaborate a little bit, we had recent discussions in the past 4 weeks about trims in Knight Therapeutics as we kind of realized the performance after its recent acquisition, perhaps a swap of TD, and we just performed a recent swap of Suncor for CNQ, which Helena will touch on later, as well as a potential new addition to the fund of its first REIT, American Tower, which I will touch base on. Going over the benchmarks, the CPMT achieved its performance target of a 7% annual return on a 1-year, 3-year, 5-year basis, and this quarter achieved an annualized return of 11%, which was over 3% higher than the blended benchmark, and we also realized a beta of 0.92. The CPMT also exceeded its goal to achieve relative returns of 100 basis points against the blended benchmark, however missed the 3, 5, and 10-year mark. The CPMT also achieved its performance target to exceed the blended benchmark on a risk-adjusted basis by 100 basis points on the 1-year timeline, however missed the 3, 5, and 10-year. I'll now pass it on to Jose to discuss the rest of performance and compliance.
Thank you, Haley. We just wanted to give a bit of an overview of the attribution analysis. We achieved a very large positive selection effect of 211 basis points in the overall portfolio. This was supported by a substantial contribution from the healthcare sector, as well as positive contributions from the energy, consumer staples, and industrial sectors. As observed by the graph below, most sectors had positive overall selection effects, which the fund believes speaks to the quality of individual names selected as holdings. On the other hand, we achieved a slightly negative allocation effect of negative 14 basis points, mostly driven by a large overallocation to the healthcare sector and underallocation of the material sector. As we previously mentioned, as the quarter has progressed, we have taken steps towards reducing overexposure to the healthcare sector. Notably, positive allocation contributions from the industrials and consumer discretionary sectors partially offset larger negative allocation effects. Our very large positive selection effects resulted in net attribution of 197 basis points for the quarter, constituting our alpha and beating our target of 100 basis points of alpha for the quarter. And a little bit on the Sharpe ratios, the CPMT did not achieve a higher Sharpe ratio than the blended benchmark over the previous 5 and 10-year period, as can be observed by the graph on the right. However, we have achieved a notably higher Sharpe ratio for the previous 3-year period, denoting improved risk-adjusted returns as of late. Now I'll pass it on to Haley to talk a little bit more about AMT.
Thank you, Jose. So over the quarter, Stephen and I looked into American Tower, which is an American REIT that owns, operates, and develops multi-tenant communications real estate and operates a portfolio of over 180,000 communication sites in 19 countries, including the US, Europe, Africa, Asia, and Latin America. It also manages urban telecommunications assets in Argentina, Mexico, and South Africa. These regions represent its reporting segments under which it operates property and services. The company was formed in 1995 as a subsidiary of the American Radio System and officially recognized itself as a REIT in January 2012. It is currently led by Tom Bartlett, the company's CEO as of 2009. On the top right corner in the left chart, you'll see the geographical revenue breakdown internationally, with the right side being its major customers, AT&T, T-Mobile, and Verizon Wireless accounting for over 51% of that property segment revenue. In terms of company history, the bottom graph highlights the series of strategic acquisitions to expand its communications tower services and assets through acquiring Viome, Telcom, Excel, SR, Global Tel Partners, etc. For instance, the recent acquisition in Intel in 2019 amounted to over 65% of Chilean towers, as well as over 85% of the towers in Peru. Moving on to company analysis. AMT focuses on strategic acquisitions to grow its international presence and asset base, accounting for $775 million in M&A to date this year, including its MTN minority stake in Uganda and recent transaction in June that gave it access to the Poland market. At the same time, it's striving to achieve its diversification in its customer base while maximizing organic growth through scaling existing communication sites and investing in formalized innovation programs to enhance the value of its existing asset to achieve an additional $1.7 billion in revenue by 2025 just through these scaling initiatives. AMT currently has a dividend yield of 1.6% with a 5-year dividend per share CAGR of 20%, whereas Crown Castle's yield stands at 2.95%. However, we believe the investors are willing to accept a lower dividend yield from AMT due to its much higher growth rate than Crown Castle, which represents 195% over the past 5 years compared to Crown Castle's at just 46%. Moving forward, in terms of its relative EV to EBITDA, AMT's middle of the pack trading multiple signals it's trading and valued in line for what the company is, whereas CCI is lower because its margins are much lower. And then on the bottom left side, you can see that AMT has a better debt coverage than its peers and has effectively reduced its net debt to EBITDA 0.4 times over the past 5 years. And in terms of competitive landscape, the AMT demonstrates more resilient performance and promising growth in contract lengths, so more stable cash flows relative to CCI's 5-year average tenant contracts remaining, whereas for AMT, 70% of its contracts don't come up for renewal until after, between 2020 and 2024, so it has a bit more time. Its growing dividend rate and its international presence to capture 5-year growth, as well as its lucrative contracts with AT&T and Verizon. Moving on to the investment thesis, despite risks highlighted on the right side, such as debt refinancing, liquidity, interest, or Forex rates, we reiterate our outperform rating on AMT based on its globally distributed macro business that is set to benefit from high growth markets, tower tenancy growth and net leverage below peers, and its AFO payout ratio that is expected to increase. And in terms of valuation, we value AMT on the basis of the average of two methods, arriving at a $295 target price, which is a 50-50 blend between price to AFO's multiple of 31 times, which is in line with current levels, as well as a DCF valuation assuming a WACC of 5.2% and terminal growth rate of, or 5.2% WACC and a terminal growth rate of 2.4%, which is aligned with its competitor SPAC. I will now pass the presentation over to Eric to discuss Canadian National Railway.
Great, thanks, Haley. So Canadian National Railway is a railway transportation company headquartered in Montreal, Quebec, trading on the Toronto Stock Exchange. It is the only transcontinental railway in North America with over 32,000 kilometers of railway tracks spanning across the coast of the Atlantic, the Pacific, and the Gulf of Mexico. It's a fully integrated and related transportation services company, meaning that it has intermodal transportation, freight forwarding, trucking, warehousing, and distribution in its pipeline, as well as of recent, relating to its balance sheet. CNR has been able to increase its current ratio towards 90% in the most recent quarter, from its historical around 60 or 70% in the previous 5 years. As well, CNR maintains a debt to asset ratio of 58% in every quarter for the past 5 years. On the bottom left, in the revenue breakdown by segment, we see their intermodal transportation as their largest source of revenue, with their grain and fertilizers coming at a close second and petroleum chemicals coming at a third. As well as their debt to EBITDA multiple has stayed relatively stable over time. And more crucially, in the last 3 quarters has maintained relatively in line to its 5-year average. Moving on to the investment recommendations. In the top left, we see the dividends, share repurchases, and payout ratio. So CNR has been able to return capital to shareholders relatively steadily over the last 5 years and has been able to maintain this slightly at a higher payout ratio in the last few quarters. So the original investment thesis was based on a healthy balance sheet, CNR's good operating ratio with a goal of increasing it, as well as their high transport volume with stable growth. We'd like to reiterate a lot of these parts of the thesis, as well as seeing that they have a new and continued financial performance and resilience throughout the COVID-19 pandemic, as well as some potential growth within the grain industry. So we hold CNR at a 2 with a target price of $154. That corresponds to an implied return of 10%. So now I'll pass it to Helena, who's going to talk about Canadian Natural Resources.
Thanks, Eric. Over the quarter, Katie and I took a look into CNRL. The CPMT already held Suncor in its energy portfolio. However, we were evaluating CNQ as a potential swap with Suncor. So to move to the first slide to give a company overview of CNQ. CNQ is a Canadian senior oil and gas producer with 95% of its production based in Western Canada. However, it also has high returns located in the North Sea and offshore Africa. CNQ's production mix is primarily oil sands. However, it is also composed of 1/5 natural gas, and this gas exposure somewhat distinguishes the company from its oil sands peers and diversifies its commodity price exposure. Moving on to the next slide to look at mandate fit. Starting on the top left, one of CNQ's most notable features relative to its peers is its FCF generation and durability. CNQ has demonstrated flexibility to adjust spending in the face of commodity price volatility, and this was illustrated in early 2020 when CNQ was able to preserve $2.2 billion of free cash flow through a combination of reduced capital expenditures as well as G&A and operating cost savings. This is further supported by CNQ's low maintenance capital requirements, which are about 75% lower than peer average. And we believe that this low capital requirements are sustainable going forward, since CNQ is mostly through its high growth phase, with phase 3 of Horizon being completed in 2017, and also by CNQ's low decline asset base, with a 10% corporate decline rate overall, thereby meaning that less capital is required to sustain production levels. Moving to the top right, CNQ has demonstrated commitment to returning capital to shareholders, especially through dividends, having increased its dividend for 20 consecutive years, including in 2020. However, the company has also demonstrated disciplined and flexible capital allocation through share buybacks, having suspended its buyback program in March 2020 to preserve capital in response to the low oil price environment. Moving to the bottom left, CNQ's balance sheet is healthy relative to its peers, with a total debt to EBITDA ratio at about 3.5 times, which is below peer average. And although CNQ did take on an additional $2 billion of debt earlier this year, it paid down $1 billion of medium-term notes in Q3, demonstrating management's commitment to delevering. And on the bottom right, lastly, we know ESG concerns have remained prevalent, especially among investors in the energy sector. However, CNQ does have some of the strictest targets among its peers in this respect, having achieved a 54% reduction over the past couple of years in GHG emissions in its oil sands segment, ultimately targeting net zero oil sands emissions. Moving on to the next slide to take a look at competitive landscape. CNQ has the lowest break-evens among its peers. Its FCF break-even is about 30 to 31 US dollars, which includes dividends. And we believe that this indicates that CNQ is best positioned among its peers to weather oil price downturns. On the top right, you can see that among its peer group, CNQ does lack a downstream segment compared to its integrated peers. However, it does have a more diversified portfolio of oil sands, E&P, and natural gas, which make up its cash flow composition. And lastly, on the bottom, taking a look at relative valuation, you can see that although CNQ leads its peers in free cash flow generation, balance sheet strength, as well as quality of its management team, CNQ is nevertheless traded in line with its peers rather than at a premium. However, it has historically outperformed peers in terms of trading performance, which is a trend that we expect to continue. To value CNQ, we applied a 7.5 times EV to EBITDA multiple to our 2021 forecasted EBITDA, which resulted in a target price of $31. And to move on to the last slide here to take a look at the investment recommendation, we did ultimately decide to execute a swap between CNRL and Suncor. So last Friday on November 6th, we divested our 1% AUM position in Suncor and added a 2% AUM position in CNQ, which represents a 1 conviction. And this was favorable decision given the rally in oil names on Monday in response to the vaccine announcement. So we were able to actually realize a significant return through executing this swap last week and increasing our exposure to the energy space. And overall, our decision to swap between CNQ and Suncor was based on our determination that CNQ demonstrated greater flexibility to sustain free cash flow generation and returns to shareholders throughout commodity price cycles without compromising its balance sheet. And while we do recognize the significant risks investing in Canadian energy, we believe that CNQ does fit our mandate while offering an extremely compelling valuation. I will now pass it back to Eric to talk about CSU.
Great, thanks, Elena. So Kian, Sina, and I also looked at Constellation Software this quarter. So Constellation Software, trading on the Toronto Stock Exchange, is an international software consolidator and provider, serving clients in a variety of industries in both the public and private domains. It was founded in 1995 by Mark Leonard to assemble a portfolio of vertical market software, or VMS, companies. And it has grown over the last 25 years to serve over 125,000 customers in over 100 locations around the world. And while it's headquartered in Toronto, Ontario, it has offices in every continent. And currently it has over 15,000 employees worldwide, and that helps the company generate revenues of over $3 billion. So the company has various acquisition vehicles, and through this it acquires companies under its target investment criteria. And the CPMT likes the alignment of values between the acquisition vehicles and looking for quality names to acquire. Moving on to the next slide. CSU has seen considerable revenue growth over the last 5 years, nearly doubling in the holding period. This is a majority in the maintenance expenses or more recurring revenue. As well, Constellation Software has been able to grow its free cash flow significantly. And we forecast and model this to continue in various segments. As well, in the bottom left, CSU, while they have seen very good appreciation and growth in the revenue, they have not necessarily increased their use of long-term debt, as well as they have used very low credit facility utilization throughout the years. And in the bottom right, they've been able to slowly increase the capital deployed for different acquisitions of companies and their investment vehicles without having to sacrifice a high return on invested capital that is very accretive to our thesis. And now moving on to the investment recommendation. We currently hold Constellation Software at a conviction rating of 2. And we model a target price of $1,726 with an implied return of 17%. Now, this is based on the thesis of CSU's ability to grow their free cash flow, as well as their ability to grow their compound their growth rate with a high return on invested capital, as well as the alignment of management incentives with the shareholders' interests. So we'd like to reiterate some of these points of the thesis, as well also see a renewed sense of defensiveness and value that we've seen over the COVID-19 pandemic. Some key considerations in this would be foreign exchange risks, considering they are geographically diverse, as well as succession planning after the retirement of Mark Leonard into the future. So at the moment, the CPMT is comfortable maintaining its position in Constellation Software as the company continues to demonstrate qualities that meet our investment mandate criteria. I'll now pass it on to Brianna to talk about Costco.
Awesome, thanks, Eric. So the consumers team looked into our current holding of Costco Wholesale. So moving into the next slide, Costco operates its warehouses internationally. The company employs approximately 240,000 individuals and is the second largest retailer in the world, second to its main competitor, Walmart, through its wholesale brand, Sam's Club. Costco is a membership-only business, and it offers 3 different memberships. And as of August 2020, 105.5 million people held Costco cards. The CPMT entered into a position in Costco in February of 2019, and our original investment thesis featured Costco's attractive business models with recurring revenues from membership fees, consistent earning beats throughout the period of 2015 through 2018, and an attractive capital structure with low debt. So you can see in the graph on the bottom right-hand side that Walmart has quite a large hold on the market, and that's including its wholesale brand Sam's Club. As well, Costco does hold a fair amount as well. And the other companies include Meijer and BJ's Wholesale. So moving into the next slide, Costco has been able to sustain its EBITDA margins fairly strongly for the past few years, and you can see in comparison with Sam's Club and BJ's Wholesale on that graph. And so touching on a few mandate points here, Costco continues to boast attractive same-store sales growth, and recurring revenues through membership fees remain. You can see in the graph on the bottom left-hand side that membership fees as percent of EBIT did slightly decline in 2020 due to a small decrease in membership fee year-over-year growth, and just due to higher earnings that weren't attributed to membership fees. Renewal rates for memberships are strong, however, at around 88.4% worldwide and around 91% in the US. Costco has a 5-year free cash flow CAGR of 26%, and its strong overall cash balance offers the ability to pay down nearly all of its debt. Another competitive advantage is the graph you can see on the bottom right-hand side. You can see that Costco's average sales per SKU is much larger than its main competitors, Sam's and BJ's Wholesale. Moving into the next slide, this year was obviously quite an unprecedented time for all businesses, but due to Costco's staple-like offerings, the company did fare quite well, even through lockdown months. So in the frequency and basket size graphs, you can see the response based on the quarters. So for Q1 and Q2, which is September through November and December through February, it was fairly normal. but in the next 2 quarters, so March through May and June through August, shopping frequency declined a fair amount. It has been able to bounce back in the US, but it stayed slightly down internationally. However, due to changing customer demand, average basket size increased substantially, and this caused Costco to see some higher out of stock positions. It is important to note that Costco was able to report increases year over year in net sales for all quarters of the fiscal year. A current concern with Costco is its lack of buy online, pick up in store, or the BOPIS feature. So the BOPIS model was brought to popularity due to the COVID pandemic, and Costco only offers this currently for higher price tag items such as technology and jewelry. And there's a slight concern due to the lack of its offering this feature. The fund doesn't view this as a concern, as Costco has been seeing its shopping frequency begin to bounce back and seeing higher basket sizes overall. As well, it's been working on its growth in the e-commerce segment, and the attraction of being able to charge fees for this BOPIS feature for retailers may soon decrease, as it's likely that fees will need to be lowered or stopped altogether. Costco completed its acquisition of Innovo Solutions in the thick of the COVID pandemic, so in March 2020. And this was an approximately $1 billion deal that Costco was able to pay with fully using cash. Innovo is aimed at helping Costco's e-commerce platform to serve more customers, as Innovo helps to provide third parties with final mile delivery and is equipped with installation and white glove care capabilities for big and bulky products throughout the US and Puerto Rico. So moving into the next slide, most of the original investment thesis still does stand for Costco. We are aware that Costco trades at a premium to peers, but for all the strengths that I've previously mentioned, and a few more that I'm going to continue to mention here, we do believe that this premium is warranted. So Costco has a strong brand recognition, and its recurring revenue through membership fees is attractive. Its development of its e-commerce platform is strong, as you can see from the graph on the right. And so partially due to COVID, the e-commerce segment did see quite a substantial increase in sales throughout the fiscal year. There is a risk of a second wave of COVID causing shutdowns throughout countries. However, Costco was able to perform well throughout the first wave of shutdowns, and so we feel comfortable maintaining our position in such a staple-like company that offers strong fundamentals and an ability to cover nearly all of its debt balance. We conservatively adjusted the model by ensuring SG&A captured any increases in cleaning costs, as well as making sure that revenue drivers remained quite baseline in case of any second waves, and this returned a target price of $380. There are a few risks that I previously mentioned, as well as the possibility of new entrants into the space. But due to Costco's strong brand recognition, we feel it will be able to maintain its hold and hopefully capture more of the market. I'm going to pass it off to Jose to discuss Intuitive.
Thank you, Brianna. We just wanted to have a little bit of an overview with Intuitive Surgical, since we acquired it 6 months ago and it went up in price quite a bit. So moving on to the next slide. Intuitive Surgical engages in the development and commercialization of the Da Vinci surgical systems, a series of robotic surgery platforms marketed to surgeons across the world. And the company splits its business activities into 3 different segments. These are systems, services, and instruments and accessories. The system segments markets the end surgical systems to customers, which are hospitals or surgeons, while the instruments and accessory segment provides users with specialized tools that accompany the Da Vinci systems. These instruments generally have embedded microchips that can determine how many times the instrument can be used. The services segment provides customers with contracted recurring services. Sorry, can you guys hear me? My computer just yelled at me quickly.
No, maybe just go back like 10 seconds.
Can you hear me though?
Yeah, you're good now.
Perfect. So yeah, going back to the services segment, this service, like I said, the segment provides customers with contract and recurring services, which include usage consulting, maintenance, and repair of the systems. And notably, the instruments and accessories and services segments compose Intuitive's recurring revenue, which consistently makes up about 70% of total. And the CPMT entered a position into Intuitive in March 2020. And as you can see from the graph on the top right corner, the company has significantly outperformed the blended benchmark during a holding period. However, the overly stretched valuations, as evidenced by the bottom right chart, remain one of the most important considerations regarding the permanence of the stock in the portfolio. Moving on to the next slide, we explore Intuitive's mandate fit. We believe that Intuitive still fits the CPMT mandate with a temporary exclusion of growing free cash flow. Before the pandemic, the company saw a 4-year free cash flow CAGR of 21.26%. Although the business was affected by the COVID-19 pandemic, we expect consistent free cash flow growth moving forward as selective procedure growth stabilizes. And another important point of our mandate fit is balance sheet strength, and the company has exhibited balance sheet strength, which is showcased by a substantial cash balance and use of no leverage. Moving on to competitive advantages, the company has notable competitive advantages. First, having enjoyed a 20-year-long first mover advantage where it has been able to entrench itself in the market unabated. Second, the fact that there are already tens of thousands of trained active Da Vinci surgeons globally. Third, ISRG's longstanding in the market has allowed it to accumulate over 3,000 patents that allow it to continuously improve its product pipeline. Fourth, Intuitive's high proportion of recurring revenue through its instruments and accessories and services segments generates consistent cash flow with low capital intensity. And lastly, the fact that the company has begun to leverage its balance sheet by providing systems through operating leases to clients, demonstrating customer centeredness. And for the last point regarding quality management, the CPMT considers that Intuitive has a highly experienced management team given executives extensive knowledge both in business and academia. This is showcased by Gary Guthertz, the CEO, his PhD in engineering sciences from Caltech, and Miriam Cutter's previous role as a professor of surgery at Stanford Medical School. And she is now Intuitive's chief medical officer. And as you can see, management has continued to accumulate stock over the years, and Mr. Guthert's compensation has consistently been tied to total shareholder return, as per the table at the bottom of the slide, which reiterates our conviction on the team. Moving on to the next slide, we wanted to provide just a little bit of an overview on our investment thesis and outlook, starting with the competitive landscape. First, Johnson & Johnson is in the process of developing an alternative robotic surgery offering, which it developed in collaboration with Google through their joint venture, Verb Surgical. However, Johnson & Johnson's extensive focus on a COVID-19 vaccine development has delayed deployment of its surgery technology, which is now expected to be released not until 2024. Moving on to another competitor is Medtronic, which is an established player in the minimally invasive surgery market, which acquired Mesa Robotics in 2018 and solidified its interest in the robotics market then. And although the company has provided little clarity on its product launch, it is expected to file for a US investigational device exemption in the coming months, allowing to collect usage data. And lastly, the last competitor is Metacoroid, which is a Japanese healthcare company that just recently received regulatory approval to market its robotic surgery device in Japan only for urology purposes. And moving on to some company-specific recent developments. First, the company is yet to provide guidance for the year 2021. And Intuitive also announced its extended use program, which will roll out in Q4 2020 and will allow select Da Vinci consumables to be used 12 to 18 times as opposed to their current 10-time limits. And additionally, the company will also lower the price of certain instruments used in lower acuity procedures, which would lower costs enough for these procedures to be competitive with conventional surgery. And as you can see from the graph on the bottom left, lower acuity procedures in the general surgery category are expected to see substantial growth in coming years, as they have seen in previous years. And after careful consideration and review of the name, the PMs decided to trim the name from a near 6% AUM down to 2%. And although we do recognize that the company has very distinctive competitive advantages and fits our mandate, we made our decision attributable to the following points. First, increasing competition as many competitors are very close to entering the market. Two, constrained hospital capital expenditures across the world due to the COVID-19 pandemic, which we're expecting to last for a little longer. The extended use program, which will inevitably decrease recurring revenues, although increasing market share, but is concerning at current high valuation levels. And four, the extremely high valuation levels exhibited by the stock, which we can see are well above 3 and 5 year EV to EBITDA averages. However, we do remain open to adding back to our position on the stock if valuation recedes in the near future, given that it still fits the mandate and it is a quality company that we hope. Now I'll pass it to Akash to talk about Lynn.
Thanks, Jose. So for this quarter, Abhishek and I decided to investigate Lynn PLC, which is the world's largest industrial gas company and was formed through a business combination between Lind AG and Praxair Inc. in 2018. The merger put together Lynn's extensive engineering and technological experience with Praxair's efficient gas distribution model, creating a significant player in the industry. The combination is expected to result in $1.1 billion of revenue and cost synergies, which are still expected to be realized through 2021. The company itself produces and distributes industrial gases through operating facilities, which are built in-house by its engineering segment, but can also create facilities for customers and distribute its gas through on-site pipelines where they create the facility. Through these facilities, they produce atmospheric gases like oxygen, nitrogen, and argon using cryogenic air separation, as well produce processed gases like hydrogen, carbon dioxide, helium, and other specialty gases. As you can kind of see on the top right there, the company has outperformed the blended benchmark over the last 5 years, and on the bottom left has a very diverse customer base with the healthcare and chemical and refining sector making up around 20% each of its sales. Onto the overall industry. The industrial gas industry is quite concentrated with 4 major players in the space, being Air Liquide, Air Products and Chemicals, Linde, and Teo Nippon Sanso. Through the last few years, consolidation has been a major theme in the industry, seen by the Praxair-Linde merger in 2018, as well as the Air Liquide Airgas merger in 2016, which has given the industry oligopolistic features, resulting in increased pricing power and ultimately higher profitability for all firms. The industry also tends to be a little more defensive compared to the broader chemical space, evident in the performance chart below, and this is mainly due to the use of long-term supply contracts that have take-or-pay features, leading to stable revenue streams and more certainty in its cash flows. Looking forward in the industry, decarbonization has become a rising theme over the last few years, and players have begun to invest in carbon capture systems and green hydrogen infrastructure to enhance their own sustainability, customer sustainability, and capture new markets. However, this is still a fairly novel idea, and there's no expectation that any of these will make a material impact on their financials in the near term. While CCS is utilized a little more than green hydrogen right now, the hydrogen opportunity is expected to be massive, which is estimated around $2.5 trillion by the Hydrogen Council, but it has seen little penetration due to the high costs associated with it. It is the belief that costs will begin to come down in the green hydrogen industry as investment in the space continues to increase, as well as regulation regarding CO2 emissions begin to increase among the world, which should result in increased prospects for the overall hydrogen industry. Moving on to the next slide, we can see that among the major players, Linde sits on top in terms of most metrics. They're a large player by EV and revenue, has best-in-class return on capital, debt metrics, and a very strong credit rating. Although Air Products has a higher EBITDA margin, Linde expects to increase its margin over the next few years as cost synergies are realized and additional projects from its large $8 billion backlog are reflected in its financials. As you see on the bottom here in the multiples chart, Linde trades just below Air Products on an EV to LTM EBITDA basis, which makes sense when you look at the table on the top right. These are the 2 premier players in the space and has quite a bit of its distribution stemming from long-term supply models like on-site and liquid bulk distribution. Moving on to our portfolio fit, Linde has a best-in-class debt ratio and has been able to reduce over the last few years. This is also supplemented by a very strong interest coverage ratio, which is around 9 terms above its peers. Its management team has also been able to return capital to shareholders consistently through the use of share buybacks and dividends, including 27 consecutive years of dividend increases. It has also been able to deliver high EPS growth in the low double digits, while expecting this to grow over the next few years as, again, cost synergies from its merger are realized and projects in its backlog come online. Linde has also been able to grow free cash flows consistently over the last 5 years, and dating back to 5 years prior to the merger, its legacy company Praxair was able to grow free cash flows at an outstanding 25% CAGR, showcasing its strong history of free cash flow generation. Lastly, like I said before, Linde has a significant backlog of gas and engineering commitments, which will contribute heavily to future earnings. As well, tagging on the decarbonization story, has already developed an integrated hydrogen supply network that positions the company well to become a market leader in the space, which they've already actually started to commit to, including investing in the first hydrogen-fueled passenger train in Germany, as well as committed to producing hydrogen in Ontario, California to supply the California mobility market. Moving on to our investment thesis and recommendation, Linde hits all the mandate points for the fund, and we are initiating a buy at a conviction of 2, pending a wholesome pitch to the fund later this month. We believe that as additional cost synergies are realized over the next year, we will see margin expansion that will bring it slightly closer to the levels experienced by Air Products. As well, increased industrial activity across the world as shutdowns are lifted will allow Linde to refocus on its plan to increase density in key geographical areas and end markets, leading to increased profitability and higher returns on capital. The company is also situated in a very attractive industry and contains a unique combination of downside protection through its fixed payment, long-term contracts, and its resilient end markets. But it also still has upside potential through an economic recovery and through its decarbonization initiatives, plus its $8 billion project backlog. Additionally, while the hydrogen market is still a few years away, Linde is positioned well right now to capture a significant portion of it through its current investments and expertise in the hydrogen market. I'll now pass it on to Drew to talk about Waste Connections.
Thank you so much, Akash. Kian and I looked into Waste Connections for this quarterly. Moving to the industry and company overview. So the non-hazardous solid waste industry has 3 primary sources of generation. So residential, commercial, and industrial waste. On the residential side, contracts agreements are usually granted by a municipality, homeowners association, or some other regional authority. On the commercial side, customers include small businesses, multifamily housing, strip malls, retail stores, and professional and other services. Lastly, on the industrial side, customers typically include large businesses such as those involved in construction and demolition or special waste such as E&P. Waste Connection itself was founded in 1997 and serves the residential, commercial, industrial, and E&P customers in 42 states in the US and 6 provinces in Canada. Waste Connection controls 96 landfills, 175 transfer stations, 66 material recovery facilities, and it also has typically long-term contracts, which are perpetual with automatic renewals. On the bottom right hand of the slide, we can see Waste Connection's different segments. And on the top right-hand side, we can see that Waste Connection has outperformed the blended benchmark on a historical basis. On the bottom left, we can see some industry trends or themes. So healthy organic growth trends have been bolstered by elevated core pricing levels. In terms of strong free cash flow generation, waste companies have benefited from the recent change to the tax regime, which has helped drive higher free cash flow conversion rates. Aggregate large cap EBITDA to free cash flow now sits at about 45 to 50%. And this free cash flow generation has provided the capital base for both M&A opportunity as well as capital allocation flexibility. Another theme that exists is very attractive pipeline for acquisition opportunities, despite the high levels of acquisitions activity in recent years. The sector remains fragmented, and management teams have indicated that the pace of acquisitions is likely to remain elevated for the foreseeable future. Some attractive industry characteristics for potential acquirers include highly visible and predictable revenue streams, stable organic growth correlated to population growth and GDP growth, generally high barriers to entry, and lastly, vertical integration potential. Currently, public companies account for about 60% of the North American waste market, but estimates say that it will account for up to 80% of the North American waste market by 2040. Quickly touching on some innovations and technologies within the sector, electric garbage vehicles have the potential to be waste fleets due to the potential fuel cost savings from EVs is greater than the existing diesel and CNG fueled vehicles. And down the road, autonomous driving has the potential to disrupt the sector, though it is still likely several years away from making its way into waste fleets. So moving to the financial metrics. On the top half of the slide, we can see a strong EBITDA CAGR standing at 10.6% and best-in-class free cash flow conversion among peers. The bottom half of this slide shows the organic growth, the top line growth in terms of organic and inorganic growth. So organic growth is really contributed by price instead of volume in recent years. And then on the bottom right-hand side, we can see that Waste Connections is a really prominent player within M&A within the waste management industry. So moving to investment thesis. A 5-year DCF with a WACC of 4.2% was used to arrive at Waste Connections' $110 target price. The model consisted of a 50-50 blend of Gordon growth, assuming a perpetual growth rate of 2% and a peer group average of 16 times EV/EBITDA exit multiple. Overall, the CPMT remains convicted on the name, and the initial investment thesis as continued organic growth and strong management team with an exceptional track record will continue to be foundational in driving value creation, not only in terms of EBITDA expansion, but also growing that free cash flow profile. Waste Connections also has a strong balance sheet and has been able to maintain a leverage about 2.4 times over the last few years, while growing EBITDA strongly in the high single digits. The CPMT views Waste Connections as a best-in-class operator with industry-leading growth profile, both organic and inorganic, as well as a strong free cash flow profile. What really sets Waste Connections apart from its peers is the company's unique positioning in attractive secondary and franchise markets, typically less competitive than urban areas, which act as the engine for Waste Connections' robust free cash flow generation and strong EBITDA margins. Backstopped by a strong management team, CPMT sees Waste Connections as a core holding within our industrials portfolio. Just touching on a few risks. A few risks include lower commodity prices affecting the E&P segment and prolonged economic downturn as revenue drivers are population and GDP growth. With that, I will now pass it off to Helena to discuss quarter in review.
In closing, we wanted to go over some of the activities that the fund has been up to in addition to the company pitches and updates that we've already presented. In response to the pandemic, we transitioned all our activities to a virtual setting, conducting all of our meetings and activities online. However, we have still been able to participate in a number of exciting activities. In late August, we were able to participate in a financial modeling session hosted by CPMT alum Jamie Wilkie at the Marquee Group. The financial analysis skills learned through this were directly applicable, especially for our investment analysts who had the annual IA Pitch Day in September. Out of the 6 names that the investment analysts pitched, there are 3 that we will be moving forward with further due diligence and potentially assessing an investment in these names, one of which was AMT, which you saw presented at the beginning of today's presentation. And over the past couple months, we've also had the opportunity to participate in a couple virtual speaker series. We'd like to thank TD Securities, Tudor Pickering and Holt, as well as Hugeson Consulting for hosting speaker series over the past couple months, and look forward to a number of speaker series that we have lined up over the next few months as well. In closing, we would like to thank the University of Calgary, CFA Society Calgary, our CPMT board, as well as everyone who attended the presentation today. We really appreciate your support of the program. We will now stop the recording of this presentation and open up the floor to questions from the audience. Following questions, we will be splitting out into breakout rooms for more informal networking should you choose to stay for that portion. However, we are excited to hear your questions. If you do have a question, you can feel free to either type your question in the chat and